because we are proud to partner with StashAway, quite a long time partner since they launched ETF that invests into Singapore listed ETFs, and certainly Nikko Asset Management, one of our, in fact, they were the largest ETF issuer as of end 2023 in terms of AUM. So we are proud to have these two dear partners with us today, bringing to you some exciting content. We just celebrated our 59th year National Day for Singapore. I hope you managed to get some good times with your family. I was at the National Day parade, and I say probably this is a very timely event to share with everyone a bit more insight into a Singapore market. I'm sure many of you might have already invested into Singapore in various forms, either through listed stocks or through the debt securities, like recently the popular T-bills. I'm sure some of you might already have vested interest in some of the bonds as well, Singapore corporate bonds, be it through direct ownership, or you might already be invested into some of the bond ETFs that we do have on SGX. So today is a very kind of a content-packed session. First of all, we will have from StashAway, Justin Jimenez. He's the head of macro and investment research, and he will be giving you a deep dive into one of their flagship method investment framework, ERAA, and how it actually helps you to optimize your investment into Singapore. Following from Justin, we're also pleased to have with us from Nikko Asset Management, Bertram. He's the investment director and portfolio manager, as well as Kenneth Tang. He is the senior portfolio manager. Right? They will be touching more into the in-depth analysis of Singapore current market, and also they'll focus a bit more into the equities and REITs, and also fixed income products, which includes Singapore. We'll touch on Singapore Treasury bonds, touch on Singapore corporates and the outlook, and how probably one of the top concern of investors is that with the potential rates cut in US and the current inflationary environment, what would be the impact on your bond investments? So I think this will be a pretty insightful session. And during the presentation, if you have any questions you'd like to be addressed, there is a Q&A session at the end. But during the session, the QR codes will be flashed on both sides of the screen. You can take out a phone, scan the QR code, and post any question you have regarding today's sharing. And at the end of it, the panelists, or rather the speakers, will join us as a panelist to answer some of the key burning questions that you have regarding investing into Singapore. Right. So without further ado, I will like to welcome our first speaker, Justin from StashAway, to kickstart today's event. Please give him a warm welcome. Thank you.
Great. Thank you, Wei Chin. Hello, everyone. Thanks for joining us tonight. So to introduce myself, my name is Justin Jimenez. I'm the head of macro and investment research at StashAway. So to begin, let me first share a bit about StashAway. So we are Asia's leading digital wealth manager, and we were founded here in Singapore in 2016. Since then, we've expanded across the region and into the Middle East. So in addition to Singapore, we have presence in Malaysia, Dubai, Hong Kong, and Thailand, and we're licensed by the regulators in all of these jurisdictions. We're also backed by some of the world's biggest VCs, including Hamilton Lane, Square Peg, Fidelity, and Sequoia. And over the years, we've been fortunate to gain a few accolades from global media and think tanks, including the FT, CNBC, and the World Economic Forum. And finally, we've also partnered with some of the world's largest banks as our custodians, so you can rest assured that your funds are safe when you invest with us. This slide shows our products on offer in Singapore. My colleagues are on the floor today in StashAway t-shirts, so if you'd like to learn anything about any of these products, please feel free to reach out to any of them, and they'd be more than happy to share. But for my section tonight, I'll be sharing some insights into how StashAway manages your portfolios, and specifically our Singapore investing portfolio. So this is the agenda for my section of tonight's presentation. First, I'll go over our economic regime-based asset allocation investment framework, or ERA for short. Then I'll share what this framework is telling us about the state of the global economy and what that means for our investments. And finally, I'll share what that means for our Singapore investing portfolio. So first off, let's dig into ERA. So our investment framework ERA, it's basically the engine behind all of the portfolios we manage. And this engine is built upon the framework of modern portfolio theory, or MPT. It's a Nobel Prize-winning mathematical framework used to build multi-asset portfolios. I won't bore you with the details, but the main idea is that, owning many different kinds of assets, for example, a collection of ETFs that invest in stocks and bonds, that's inherently less risky than owning just a single kind of asset. So in short, our portfolios are built on the foundation that diversification is the key to managing risk and return. Now, ERA further builds upon MPT by taking into account where we are in the economic cycle. So this is basically a basic graph, an illustration of the business cycle where the economy goes up and down, output expands and contracts, inflation goes up and down. So at StashAway, our ERA framework looks at the economy across these two axes of growth and inflation, and then it separates them into 4 quadrants, or what we call economic regimes, hence economic regime asset allocation. And I'll just quickly walk you through them here. So first, when growth is high, inflation is low, this is what we call good times. So the economy is in good shape, right? Consumer demand, business investment, it's strong, prices are stable. In this environment, stocks tend to benefit from healthy profit margins. So growth means that businesses can increase sales, and low inflation means that costs are stable. In this environment, though, bonds don't tend to perform as well as investors shift to riskier assets. That said, over time, strong growth tends to heat up the economy and lift inflationary pressures, and then we move into what we call inflationary growth. In this regime, stocks also tend to do well, but margins can be pressured by higher input costs. For bonds, high inflation is generally not great. And also during this regime, central banks tend to start raising interest rates, which further puts pressure on bond prices. What's next? So interest rates start to weigh on growth, and the economy moves into what we call stagflation. So here, margins are squeezed by poor growth and high costs. Equity markets don't tend to perform very well, though some sectors, that said, can perform better than others. Bonds are also squeezed by high inflation, but that said, in this regime, real assets like gold tend to perform better. So finally, in this last stage of this typical economic cycle, the economy moves into recession. So weak demand brings down inflation. Central banks are able to cut interest rates. Bonds do better. As rates decline, investors move to safer assets, and equities can start to gain on expectations of rate cuts. And then that brings us back full circle to good times. So in a nutshell, this is how ERA looks at investing across the economic cycle. And as I discussed, the returns for asset classes can differ depending on where we are in the economic regime. So this chart shows historically how they've performed under each of these regimes. So this chart shows in blue the S&P 500's returns, and in yellow the returns of long-term U.S. government bonds. And ultimately what this illustrates is 2 things. So first, it's the importance of diversification and allocating asset classes to minimize your risk and maximize your returns. And secondly, it shows why it's important to keep an eye on where we are in the economic cycle when you allocate across asset classes, and that's what StashAway does for you. So moving on, in this next session, I'll focus on the latest signals that we are seeing, from ERA. And in short, based on the economic data that we monitor, ERA back in April signaled a move back from a regime of stagflation to one of inflationary growth. And as I shared earlier, the normal business cycle tends to go clockwise from good times to inflationary growth to stagflation to recession. But this past business cycle wasn't your usual business cycle. We saw extraordinary stimulus, dislocations in the labor market and rebalancing thereafter. So that's meant the economy has moved in pretty unorthodox ways. So what's triggered this shift back into inflationary growth? So what we're seeing is that the stimulus and these shifts across the economy have allowed it to remain relatively resilient. So this chart shows 2 things. So the yellow line, that shows the 3-month moving average of the global manufacturing PMI. For those who don't know, the PMI is a measure of economic activity. So a reading above 50 means that, that signals expansion. Below 50 signals contraction. There's a red dotted line there that shows that line. So you'll see that about earlier this year, it moved back into expansion after being in contraction for about the past year and a half. And these blue bars here, these show growth in global equities expected earnings per share, or EPS, over the next 12 months. And you'll see that this has been recovering as well, recovering in tandem with the global PMI, because a recovering economy is positive for company earnings and thus global stocks. So you might have noticed over the past week, there's been a lot of volatility in markets. So the big question is whether this can be sustained. So last week's ups and downs were driven by some softness in the U.S. economic data, particular some weak jobs numbers from the U.S., though it's important to note that that had some seasonality to it, some one-offs that impacted that data. So let's zoom out to the bigger picture, and this is sort of a longer-term view on the labor market. Basically, this shows the strength of the labor market by taking the difference between people who say they think that jobs are plentiful minus those that say that jobs are hard to get. So if the number is positive, that means that more people find it easy to get jobs than not. And what you'll see that this number has come down over the past year or so, but it's still in positive territory, or about 18 percentage point difference as of July. And other measures of U.S. Job openings to unemployed, the other labor market indicators are also sort of showing similar things. And what this tells me is, the economy is cooling, but it isn't necessarily slumping or in contraction just yet. And I think that's a really key distinction at this juncture in the economic cycle. One more thing I wanted to note is, there's uncertainty over the U.S. elections, especially since VP Kamala Harris entered the race, and that could add to some near-term volatility in markets over the coming months. So this passage I've highlighted in red is some commentary from the makers of the global PMI, S&P, and it basically says that firms are putting spending and investment plans on hold until the outcome of the next election is more clear and there's more certainty in what will happen, and that could lead to some softer economic data in the coming months and perhaps a bit of volatility in markets. That said, one thing to remember is that political events tend to result in a lot of short-term noise. We saw one example from earlier this year was the general election in India, when markets sort of swung down and then back up again as sort of the results were tallied. And why I say that it's noise is that, over the longer term, what most elected officials care about is staying elected. And staying elected usually means that you want the economy to be in good shape. And when the economy is in good shape, that's generally positive for markets. Okay, so put everything together. So ERAA signals, our analysis suggests that we're likely to remain in this regime of inflationary growth for the time being. And now, what does that mean for how we approach investment? It means that we've been putting cash to work. So that means moving away from cash equivalents and more towards risk assets. So this chart focuses on U.S. assets again, but what it shows is that equities, in particular the more cyclical part of equities, tend to outperform cash in periods of inflationary growth. So over the past 20 years, U.S. industrial equities have had excess returns over cash of about 10% during this economic regime. And meanwhile, longer duration bonds have posted returns that were well below that. Finally, before I pass the stage to our partners at Nikko Asset Management, I'd like to connect our ERAA framework to how it plays a part in our Singapore investing portfolio. So how is our global macro framework helpful in managing Singapore-focused assets? For one, Singapore is extremely plugged into the global business cycle. So you'll often hear economists referring to Singapore in economic jargon as a small open economy. Basically, all that means is that, due to its small size, it needs to tap into the global economy to grow. This chart just shows Singapore's trade flows to other economies in 2023. In total, that amounted to about $722 billion last year. And to give you a sense of that scale, Singapore's GDP is about billion US dollars. So trade stands at about 1.5 times GDP. And that's important because it means that because of its reliance on external demand, the Singaporean economy can be exposed to global headwinds. So in the last chart, we saw that Singapore's two largest trade partners, the US and China, accounted for about $90 billion of total trade last year, about 25% of the total. So if those economies face challenges, then that can have a big impact on Singapore's economy as well. On the other hand, the country can also use its connectedness into the global economy to ride global tailwinds. So one recent example of that is Singapore tapping into SWIFTonomics. So that was a pretty decent boost to the economy via the services exports channel last quarter. I think estimates were about 400 to 500 million of additional GDP in 1Q. So that's 0.2 percentage point for a single quarter. That's pretty sizable for a concert series. So that said, this could be a one-off bump, but I think what this illustrates is that how Singapore's investments in tourism infrastructure, for example, can be used as a lever for the economy's growth. So putting it all together, we can see that the Singaporean economy is still holding up, and that's been supported by the outlook for external demand. So this chart again shows PMI gauges for Singapore. One is for the broader economy, that's the white line on top, and one focuses on the the Singaporean manufacturing sector, that's the light blue line at the bottom. And again, the 50 mark is demarcated there by the dotted red line. And by both measures, we can see that the economy is above that 50 mark, and so the outlook is still a bit optimistic. I mean, in fact, that sentiment was shared by the MTI this morning. Saw GDP coming in the upper half of their forecast, so about 2 to 3% for the year. So that leads me to Singapore investing. That's our multi-asset Singapore-focused portfolio managed by our ERAA framework. So this portfolio invests in SGX-listed ETFs, including Singaporean equities, bonds, and REITs, which are largely dividend-paying assets that help to generate passive income across various market conditions. And then our ERAA framework on top of that helps to keep risk constant across the economic cycle. So what does this look like in practice? So back in April, when we optimized our ERAA-managed portfolios to account for this shift back into inflationary growth, we also rebalanced our Singapore investing portfolio. And so given this environment, we reduced our allocations to money market funds and reallocated those assets across the board to Singapore REITs, to bonds, to equities. I'll leave the detailed market outlook to our partners at Nikko Asset Management, but I just wanted to share one point about the Straits Times Index in particular. I think what's really interesting about the STI is that it's offered quite a sizable dividend yield on an absolute basis and also relative to other markets. And that's widened a bit actually over the past few years. So this chart shows that its current yield is about 5 to 6% versus about 4 to 5% for the Hang Seng and 3 to 4% for the Euro stocks. So, this dividend yielding sort of attribute of the market can be attractive for those of you who might be more income-focused investors. This next slide shows how our Singapore investing portfolios have performed over the past 12 months. So the main takeaway here is the power of diversifying portfolios across asset classes. I'll just focus on the far left section, which highlights our portfolio. So this shows that over the past 12 months, our portfolio has generated total returns of about 6%. That's the far left light blue bar. It's also had an average dividend yield of about 3.6%. That's the medium blue bar. And finally, it's had a lower risk compared with each of these individual asset classes. So its volatility over the period was just under 4%, and that's the dark blue bar, the far left. And put it all together, and that's meant that our portfolios offered better risk-adjusted returns compared with investing in just a single underlying asset class. Finally, I just wanted to zoom out on and share how our portfolio has held up over the past few years of challenges in the markets. So this shows our annualized performance since the portfolio's inception since late 2019. Again, I think this highlights how diversified exposure has helped to manage risk over the medium term, especially given downturns in big asset classes like REITs and some sections of the bond market. And in this environment, our Singapore investing portfolios offered a combination of steady dividend payouts of about 3.4%, as well as lower volatility versus just investing in stocks or sort of REITs alone, for example. So That's my part of my presentation. Thanks everyone for your time and attention. I'll just pass the floor now to Kenneth Tang, our Senior Portfolio Manager at Nikko Asset Management. Thanks everyone.
Well, thank you, Justin. Welcome everyone this evening. It's our pleasure from Nikko Asset Management to come down together with StashAway for our presentation today. So, as Justin would have shared, we have two speakers, myself being the first. And what I will try to do over the next 20 minutes is to really cover perhaps our views in Singapore equities and Singapore REITs, or better known as Real Estate Investment Trust. But of course, a first quick word on Nikko Asset Management first. Just as an introduction, Nikko Asset Management is predominantly an Asian-based asset manager. We are clearly very performance-driven, but we also hold a very big global perspective in our investments. We run many strategies in Asia, but we do originate a large part of our assets under management in Japan as well as in Asia. But when we go closer to home, which is really the topic for today, Nikko Asset Management is also one of the largest active and passive asset managers specializing in Singapore equities and Singapore bonds. So do pay us a visit at our booth because we'll be very happy to share you more about our Singapore funds. Very quick word about myself. My name is Kenneth Tang, and I've been managing money for a good part of the past 28 years. And within the focus of Asia, I've actually been focused a lot in my last 28 years specializing in Singapore equities. Nikko Asset Management, I've actually managed both the Nikko active and passive strategies. Some of you may know some of our active funds such as the Nikko AM Shenton Thrift or the Nikko AM Singapore Dividend Fund. And I also manage the STI ETF, which we'll focus a lot more today for our presentation. But let's go straight into the outlook for Singapore, and we'll start with an overview of Singapore equities. Now, as Justin have shared, clearly Singapore is a very decent investment case for investors. We think it's an attractive asset class, the STI, and we have just celebrated a very wonderful National Day over the weekend, so we can count our blessings in really where we live in Singapore. Likewise, there are many positive attributes in investing in Singapore equities. I've actually distilled the investment thesis into three key cases for today's presentation. The first is we think Singapore is a defensive safe haven. It's actually a diversified economy, and the equity market actually provides a lot of resilience against the macro headwinds. We also have what we call a very flexible monetary policy and a strong fiscal regime to help calibrate the economy in times of stress. Take, for example, the many crises that we have seen over the past 10, 20 years. We have actually come through well because of good policy making. The second point is really understanding Singapore's roots as a trading nation. Today, we are actually an investment hub for Asia. And we know that, in the recent Singapore MAS survey for the fund management industry, the Singapore AUM industry has grown by another 10% to an AUM of 5.4 trillion. And this is actually a lot faster than the AUM growth, the assets under management that Asia actually offers. So we have already seen how Singapore can really succeed itself in building itself as a hub for business and investments. Finally, Singapore is also changing. It's also evolving. Today, Singapore is fast emerging as a growth hub for renewable energy, technology, data, as well as logistics. So companies in the STI don't just give you exposure on the usual banks and property sectors, it also gives you exposure to some of these leading growth sectors as well. And when you look at the scorecard, Singapore has not done too badly in terms of performance over the past 4 years. So I've taken the liberty of just showing performance since COVID or 2020. And Singapore has actually come through fairly resilient. It may not have done as well as the S&P, which I know tops a lot of global market averages. But against Asia and against obviously also a very thriving Japan market, Singapore has actually generated close to about 4.6% in annualized returns since 2020. So it's actually been a steady and a defensive return framework that's characteristics of the Singapore market. Now, the bigger question today is why now? And I think many of you investors will be wondering, is this a good time to look at Singapore equities for today? Well, especially after, I think the numbers that Justin showed just now ended in July, and we can actually see how volatility have been quite high in the case for the last couple of weeks. So the question is, after the sell-off that we have seen, is it a good time to step into Singapore? We think so, because we think that it's actually an attractive investment proposition. Number one, why Singapore today? Because Singapore market does still offer positive earnings growth. And we think that earnings growth is going to be still supported in the coming years, will be positive, reflective of a recovering economy, both domestically and globally, as well as continued supportive policy, which I will cover a little bit later in one of our charts. The next thing is to also consider where we are in the monetary cycle. We are about to step into a time of rate cuts. So periods of rate cuts have actually been associated with actually good performance for Singapore equities. That effectively can be quite intuitive because effectively it means that lower cost of borrowing helps to fund businesses better to deliver earnings growth. So it's actually a good time considering the likely cuts that we will have in interest rates in the coming quarters. And finally, valuations. Singapore is fairly cheap with low PE and PB ratios, price earnings and price to book. And dividend yields, as shown earlier, is very attractive at more than 5%. So very quickly, a few charts to just amplify some of the points I shared. The first is when you look at the outlook for Singapore, you can see a very nice correlation with the STI and the economy. So what essentially it shows is that Singapore economy actually is a good driver of the STI, and it mirrors the steadiness and the stability of the underlying economy. So if we believe that we are on the cusp of a global recovery, where Singapore economy should improve, we believe the STI will also do well. The next point is a little hard to see, but I think I wanted to highlight that EPS growth, which is actually a very important driver for the equity market, has been actually steady to rising over the past 1 to 2 years. And this is the nature of really where we think with higher EPS growth, the expectation of higher earnings should translate into price performance. So we think this is actually a good thing that higher EPS growth will actually drive the STI going forward. Now, this is a little bit more technical, so do bear with me as I explain what this chart does. It's a model of mine which tries to map out the STI performance against periods where we have monetary easing and monetary tightening. And when we look back over the last 25 years, one can observe there have been different economic cycles in Singapore. Some of you may remember the Asian financial crisis, and some of you may even remember the global financial crisis. But at these times, monetary policy do change, and that actually has an impact on market performance. Periods of tightening, if you can see the lighter shade of green, has actually been associated with times where the economy is perhaps too hot or where inflation is a little high. And this has led to lower returns for the STI. Not necessarily negative returns, but returns have been actually closer to mid-single digit. But when you look at the other periods where the times where we had looser policy, you can actually see that STI returns actually improve significantly. In a couple of the green bars, you can see that returns of the STI has been as high as 9.3% on an annualized basis to closer to about 6% in the periods that were before COVID. So what am I suggesting here? I think what I'm trying to say is that if we are entering a time of looser monetary policy, or what we call neutral policy for the trade-weighted basket in Singapore, we think that STI should actually perform fairly well in these times. A last couple of charts before I go into Singapore REITs. Valuations stack up quite favorably. We have the price-to-book ratio for Singapore of close to 1 times, which is essentially a good base to build returns upon. And price-to-earnings ratio is also looking attractive at 11 times. And given I mentioned about how trajectory of earnings should improve, we should also see better performance for the STI going forward. My last chart for the Singapore equity market is fairly similar to what was presented earlier. Singapore dividend yield is actually a head above the rest. And it's actually very much characteristic of Singapore to be a high dividend paying market. And that makes actually Singapore fairly attractive, especially when we think about yields coming down. The premium on dividend yields will clearly be a beneficial advantage for Singapore. Now, moving lens to REITs, I would say that the sector is also looking interesting for us at Nikko Asset Management. The difference between Singapore equity and Singapore REITs is a little bit more about what we call dividend streams. So we think, number one, that a sustainable and growing dividend, or what we call DPU, is more important in driving Singapore REITs as an asset class, as compared to the STI, which is more driven by EPS or earnings. Singapore REITs pay out 100% of their earnings, and that often means the yield proposition, how much the dividend yield of REITs will matter a lot more in the case of investing in REITs. And we believe that the dividend story for REITs is actually quite encouraging. We see today many data center logistic REITs are growing, representative of the new economy, and that should actually continue in the years ahead. The second point of why we think REITs are looking more attractive today is because REITs actually offer more defensive and lower volatility compared to other equity indexes. It's a bit similar to bonds, where I think the repeatability of what we call DPU or dividends per share, per unit, actually suggests that this is actually a stable asset class to invest in. And finally, we think that this asset class will continue to grow. As SGX can clearly attest, 15 years ago, there was hardly a representation of REITs in the Singapore market. Today, more than 10% of the market cap of the entire Singapore market is actually represented by real estate investment trusts in REITs, and that will continue to grow. So we think this is actually a growing sector that is also looking interesting for investments. The same chart performance highlights a slightly different picture. Unlike the STI, the Singapore REITs would have done a lot more restrained performance. If I can be obviously a bit more realistic, I mean, the performance of the STI REITs have actually been quite dismal. It has been quite flat, but this is actually quite in line with what we see globally in all forms of REITs. In fact, the Singapore REITs have actually done fairly decent compared to other REITs in other parts of the world. So while it's a bit pale compared to the S&P or the STI, the REITs in Singapore actually has offered a lot more stability compared to some of the global REITs, which has fared a lot worse. So on a total return basis, I think the key message in this chart is that REITs offer a fair level of defensiveness and stability. And again, what do we think about REITs today in the current environment? We think that with rates likely to fall in terms of interest rates, we are quite constructive on Singapore REITs going forward. There's a very high likelihood that the rate cuts in the coming quarters could be quite reminiscent of what we saw in 2019. In 2019, where we saw the series of rate cuts, the Singapore REITs actually performed very well, totaling double-digit returns over that period of time. The second point is that the demand story for REITs is also anchored by the continued investment in data center and logistics supported by AI, and we think that will continue to be a demand story for the REITs in Singapore. And finally, because REITs are very much compared with yield propositions against other fixed income asset classes, the good news is that the current dividend yield for the S-REITs or the Singapore REITs is actually yielding close to 5% or more than 5%, and pegged against the Singapore 10-year bond yields, which is slightly under 3%, is giving you a fairly decent premium. So a few other charts to wrap up my presentation is really talking about some of the key points I mentioned earlier. So you can see again, there are two shades of green. The green chart, which is lighter, highlights obviously the inverse of what we call the MAS 2-year bond rates. I use that as a clearer barometer of short-term interest rates. So the fact that it's actually rising now highlights actually falling rates that is starting to take place. As many of you know, T-bill rates have come down, and this is likely to continue to come down going forward. So what that means also is that the correlation with the REITs, which is the darker shade of green, should also be coincident, meaning that we should start to see falling rates being represented by better performance in the Singapore REIT sector. So in the bottom line here is that REITs can do well when short-term interest rates start to move lower. And this is a back study by Bank of America. And if we look back over the last 10 years, positive performances for REITs tend to happen when bond yields fall. It typically is actually a case where when the rate cuts happen, performance in REITs typically are positively correlated with how much rate cuts happen. And the deviation between whether it becomes a good year for Singapore REITs or a less good year for Singapore REITs comes down to how much they cut, and obviously whether Singapore, which is the domestic market, ends up being in a recession or a soft landing. So if the view is that we're going to get more cuts and yet also a soft landing, the performance for REITs can be very attractive. So this is actually closer to our more central scenario, that we may see a series of cuts, but yet Singapore not going to a recession. That would mean positive outlook for the Singapore REITs market. Couple more slides before I pass on to my esteemed colleague. This chart really just highlights again the long-term story for Singapore logistics. You have heard the sharing of how Singapore is plugged into the global economy. That is very real and powerful for REITs in industrials, because industrial REITs and logistics REITs are basically the bellwether of the structural trend in e-commerce. So as much as we are doing more e-commerce today than we did 5 years ago, that trend will also continue to grow and be a supportive narrative for the REIT sector in logistics. Furthermore, FDI is something that Singapore continues to do very well in garnering globally, and we think that will also feed positively for the sector. So this highlights the yield spread of bonds, of REITs versus bonds, which my esteemed colleague Bertram will cover in a minute. But what you can see here is what we call the yield carry of Singapore REITs versus the 10-year bond yield. And you can see it across many other markets. You can see that in Singapore and Hong Kong, it's obviously a lot more attractive, including Japan. And that also becomes another reason why we feel that the premium of REITs is actually attractive, because that spread historically is a good indicator of where REITs can be more interesting for investors. So if I can sum up the case for Singapore equities and REITs, we are fairly constructive on both asset classes. Number one, Singapore equities is a defensive and resilient proposition amid global headwinds. Singapore equities is also a growth proposition, something that perhaps the market is not as well aware, is plugged into the future of Singapore's growth economy. And Singapore REITs is a story about sustainability and growing dividend streams with good risk-adjusted returns. And lastly, Singapore REITs is well positioned with rate cuts coming and also attractive yield proposition. I do need to highlight some of the risk factors because this is probably our commitment to investors. There are some risks that we need to consider because the equity risk for Singapore is really coming more from the ability to sustain growth in earnings. So the risk factors will include obviously volatility to do with earnings growth, as well as interest rates. Should we be wrong and interest rates go up, that could obviously put pressure on markets as well. Last but not least, investors should take cautionary action when investing in equities and seek advisory opinion whenever possible. Likewise for REITs, we think that REITs will definitely be a lot more sensitive to interest rates. So again, that will be the key risk factors to consider for investing in REITs. And the revenue exposures also will be linked towards the growth in the global economy. So finally, do visit our website if you have more questions on the Nikko funds. And clearly, this is actually one of our advisories that we hope all investors will be familiar with as well. So for that, I'll pause and I'll pass the time to Bertram, my colleague on fixed income.
Hi, good afternoon, everyone. Good evening, sorry. So I'm Bertram Sarmago. I'm with Nikko Asset Management. I've been with the firm since 2014 and managing Asian fixed income strategy, managing the Singapore bond ETF. So in my section, I will be talking about, sorry. I'm sorry about that. Yeah. So I'm just introducing myself. So I've been with the firm since 2014. I've been managing the fixed income ETFs that we have. We have currently 2 Singapore dollar bond ETFs. One is focused on government bonds. The other is focused on corporate bonds or non-government bonds. We've managed the government bond ETF since 2005. It was supported by central banks in the region to develop local bonds and to encourage more corporate bond issuance. And so in 2018, we've launched, in line with government support, a corporate bond ETF, which invests in statutory board bonds and corporate bond credits in Singapore. So I'm going to talk about the market first, which is the Singapore fixed income market outlook. And the other section will be talking about the 2 bond ETFs that I've talked about. So on the Singapore fixed income market outlook, the first part of talking about Singapore fixed income is first about Singapore monetary policy. Singapore monetary policy, as some of you may be aware already, is unique in the sense that the US and all the most other countries use interest rates in managing inflation. In Singapore, we have this thing that we call the Singapore dollar nominal effective exchange rate, which is managed by the MAS to address inflation. So the SGD-NER is a trade-weighted basket of currencies, and it ensures that the currency is being used to address inflation. So you can see here on the chart on the right, which is Singapore inflation, which has been very much picking up from 2021 after the COVID reopening up to 2022. So what we saw was inflation on the headline side close to 8%. And you can see the core peaking at around 5.5% at around early 2023. So what the MAS did was really manage the SGD-NER on an appreciation stance to ensure that imported inflation is being addressed. So we've seen this being adjusted up to around October 2022, where the Singapore dollar effective exchange rate was appreciated both from a appreciation stance as well as revalued to a more stronger Singapore dollar. And you can see that in the performance in the last 5 years, or even through from before COVID to now, Singapore dollar has been the strongest currency in Asia. And also, even when you compare it with major currencies, the Singapore dollar has been one of the strongest currency versus the US dollar. And so inflation has been declining since 2023. Recently, we had a core reading of around 2.9% for CPI, and then headline CPI at around 2.4%. The MAS is forecasting core CPI to around 2.5 to 3.5 this year. That's still relatively high compared to the pre-COVID core CPI of below 2%. So we still expect on our end to for the SGD-NER to be managed on an appreciation stance. That's what we Kenneth mentioned earlier, a more neutral stance. There's no change or increase in the appreciation slope. but we think that the current stance will be maintained at least until next year, given that inflation is still above the 2% level. And so given this stance, we do expect the Singapore dollar to remain strong, at least this year until next year. And also we expect the SGD even to outperform the US dollar, given that the outlook for the US Fed is on the cutting of the interest rates, which is on this slide about the US dollar fixed income. So Singapore dollar bond market is very closely correlated to the US fixed income. And so we do ourselves, both from our active management of our bond strategies, monitor the US Treasury bond market quite closely. And the US monetary policy is one of the very important market event that we closely follow. And that is monetary policy in the US is based on the labor market and on inflation. So the first chart above is the US non-farm payroll levels, where in every first Friday of the month, you will have the US NFP or non-farm payroll and their unemployment rate. And this is an indication of how strong the US labor market is. So this is a big news economic event that we monitor on the first week of the month always. And given the strong labor market in the US since the COVID reopening, they've been increasing interest rates. It's been quite strong in the last few years. Average 2023 was around 250,000 a month, and 2022 around 380,000 a month. And in the last 3 months, that has actually eased around 170,000 in the last 3 months. So quite a significant weakness when you compare it to last year. In terms of the unemployment rate, last year, the lowest was around 3.4%. In December, 3.7%. But in the last print, it crossed 4.3%. So crossing 4% and putting into 4.3% was actually one of the triggers that led to market being concerned about recession risks. And so you saw that equity sell-off in early August because the August print of the unemployment rate was at 4.3%, which is quite fast compared to the 3.7% unemployment in December 2023. In terms of inflation, you can see here the direction of inflation, which has been going down at a 5.6% peak in Q1 of 2022. And currently it's around 2.6% in terms of the US core CPI. There was a sort of like a month-on-month pickup in early 2024. That's why we saw yields in US Treasuries pick up to April, but that has eased again. And so we're seeing easing inflation and more in-line inflation expectations. And I think our view is that the inflation in the US is going to normalize and move down to the 2% target of the US Fed. That's why we're seeing more talk about US Fed rate cuts coming. In April 2024, the market was expecting only around 1 rate cut this year. Once we saw labor market weakening, currently the market is pricing around 4 rate cuts this year. And we think that's optimistic in terms of rate cuts. Our view is that the Fed might be cutting rates, but not at a 4-cut level, given that's sort of like a very optimistic in terms of rate cuts. But we do expect that rate cuts will start in September, and it will be a 25 basis rate cut, and there's 2 more meetings, so we think around 75 basis points of cut this year, and essentially that will be positive for bonds. And you can see how historically when the Fed was been hiking interest rates, US 10-year and the Singapore 10-year rose together, but around around 2022, early 2023, the US Fed, the US 10-year Treasury continued to increase, but Singapore bond yields continued to just be around the 2.8 to 3% level. It's because one of the reasons is that US Treasuries have been rising because of fiscal concerns. Singapore doesn't have that. And the other concern is recently is more on the geopolitical risk. Singapore is more of a safe haven, and in that sense, the AAA quality of the Singapore yields has supported the bonds of where it is now. Currently, the Singapore 10-year is around 2.8% when you compare to the US 10-year, which is around 3.9%. We do expect that yields is going to go down from here. Rate cuts is going to start soon, and that is dependent on inflation. And inflation, we do expect it to start and continue this inflationary trend. So how is Singapore credits and Singapore bond yields doing? So in terms of Singapore credits, that's the line on top. Since 2013, it moves around the 3 to 4% level. The lowest level was around 2% in 2021, but as the Fed started to hike, we saw Singapore credits yield go up to around 4.8, 4.9%. And since the improvement in inflation, since the expectation of market that the inflation is trending downwards, you can see yields also going down from around 4.8%. Currently, the yield is around 3.6% for the market for SGD corporates. On the other hand, Singapore 5-year, which is the government bonds, it's been oscillating around the 3% level since late 2022. But we do expect that from here on, the direction will be more on a downward trend for bond yields, both for Singapore credit and for Singapore government bonds. And in terms of returns, as we all know, when yields are going down, returns are going to be improving as well. And later on, we'll be showing the historical performance of the Singapore dollar bond market, both for government bonds and corporate bonds. This chart shows the investment grade credit spreads. So this is the spread or the additional yield that you get when investing in corporate bonds. This is investment grade corporate bonds. So historically speaking, it's around 100 basis points or 1% above the Singapore government benchmark. And when you compare it with Asia credit investment grade, it's actually relatively tight. Currently, we have spread of around 70 to 80 basis points, while investment grade Asia credit has around 140 to 150 basis points. One of the reasons is, of course, this is a higher quality AAA kind of issuers. A significant portion of the Singapore investment grade market is AAA. You have HDBs, a lot of thematic link companies. So that's around 30 to 40% of this market are stock boards and thematic link companies, almost half of it. So that's why it's relatively tight if you compare it to other credit markets. But in terms of outlook, the fundamentals of these issuers in the Singapore credit market is not going to deteriorate significantly. These are all investment grade issuers, and we do expect spreads to just range around the 100 basis points level. And of course, there's a strong demand for Singapore credits. A lot of, Kenneth has mentioned about the wealth creation that's in Singapore. So there's strong demand both from fund managers, from banks, as well as private wealth. So this continued demand for Singapore dollar credit has actually supported the performance in the last 5 years. And if you even look at volatility, because a lot of these investors are buy and hold, it tends to have a lower volatility. It actually has half the volatility of government bonds, which is quite interesting, given that credits usually should have a higher volatility than government bonds. The other factor, of course, is that government bonds have a higher duration, and higher duration usually means higher volatility for bonds in general. And so what's in the Singapore dollar fixed income market? So this is a 240 billion kind of market. We see around 20 to 40 billion of issuance, 20 billion of that coming from the SGS, and around 20 to 30 billion coming from the non-SGS market. So we've been seeing active issuance, not just from Singapore domestic link companies, not just from Singapore companies, but also foreign issuers are also active in this market. For example, in the non-sovereign investment grade index, around 20% or higher is coming from foreign issuers. A lot of foreign banks are actively issuing in the Singapore dollar bond market. In terms of markets, the ABF Singapore Bond Index, which is the index that we follow for our government bond ETF, is around 152 billion to 190 billion. And the corporate bonds is around 90 billion in terms of market size. It's relatively small, but we are able to track this market from an ETF perspective quite closely. Our tracking error is still within our expectations. For the government bonds, it's around 10 to 20 basis points, and for corporate bonds, it's around 30 basis points. So what's in this government bond ETF? So when you buy the ABF Singapore Government Bond Index, 79 to 80% of it is SGS. The government is a very active issuer in the Singapore dollar bond market. So every last days of the month, the Singapore government usually issue bonds. There's an auction schedule that's being set at the start of the year. And so we do know what bonds will be issued. Like, for example, in the last auction was a 2039 bond. So the maturity is 2039 bond. And so the yield of that bond was around 3.02%. So if you hold that bond to maturity until 2039, a 15-year bond, you'll get 3.02%. And the HDB is also one of the active issuers in the market. So it's around 12% of the ABF Singapore Bond Index. We do invest both for these two ETFs in the statutory board bonds. If you see on the table below, when you invest in bonds, you look at yield, you look at duration, you look at credit rating. The first thing that you look at is yield. How much do I get from buying this bond? It could be a single bond, it could be a portfolio of bonds, which is this ETF. So for the ABF Singapore Bond Index ETF, you get 3.2%. This is as of end June, but currently it's around close to 3%, given the market rally recently with yields going down from the risk of environment. So you get around 3% by buying this ETF. The duration, which is a measure of interest rate risk, the higher the duration, the more volatile the portfolio will move compared to, let's say, a short duration bond fund. If you look at 7%, you just think of it as a 7-year duration. You look at it as when 1% goes up in terms of interest rates, you will lose 7% of your market price. But if yields go down by 1%, this portfolio will also return 7%. So it's just a rough rule of how to read duration. In terms of credit quality, it's a AAA credit. Singapore government is rated AAA. So it's a high quality investment grade AAA ETF that gives you around 3% of yield. In the AAA space, this is one of the higher yielding AAA government bonds. I think the higher one will be Australia. On the corporate bond ETF, so we invest in investment grade bonds. The biggest of the ETF are banks. So as we said, the local banks are also active issuers, but we also have foreign banks that are also active issuers in this market. I'd say around 10% is coming from the Singapore banks. Around 10 to 20% comes from foreign banks. The next issuer that are active in the market are the stock boards, your HDB and LTA, and the rest will be distributed by financial institutions, insurance, REITs, real estate companies, and other domestic link companies and other issuers in the Singapore corporate space. You might wonder why REITs is in here, because REITs, they also issue bonds in the market and to raise capital. And you can see the yield of the corporate bond ETF is around 3.6%, 3.7 currently. And the duration is lower at around 5.6. In terms of credit rating, it's still a high quality investment grade ETF. It's at a single A average rating. If you look at US credit, the average credit rating there is around triple B. And so this is a high quality investment grade corporate bond portfolio. So how has these two bond ETFs performed? The first chart on top is the average yield of the index. So this is the average yield of the bond ETF that you're getting when you invest in this ETF. Historically, in the last 10 years before COVID, the government bonds on average would around be 2 to 2.5%. And as interest rates were cut during the COVID period, interest rates actually went down to as low as 1%. So once the market reopened, yields have started to go up, and the highest level of the index yield was around 3.5%. In the last 2 years, since Q4 2022, it's been oscillating up and down, given we're still not sure whether inflation is out or inflation is in. It's been more volatile in and out for government bond yields, but it hasn't gone up beyond the 3.5%. So we'll see where this will lead us, but we think that from here on, we'll see yields starts to go down from the 3% level. And you see that in the August period, during the risk off when market were concerns about recession happening, we see yields go down to as low as 2.8%. This has normalized now to around 3% level. So we do think that yields in the medium term will be going down, and that will be good for bond market performance. You can see the calendar year returns at the table at the chart below. Prior to COVID, on average, we have around 2 to 3% of returns when you buy government bonds. And in 2021, after the market reopened, we've had negative returns for the government bond market. In 2021, minus 5%, 2022, minus 6.4%. But it has since recovered that. 2023, we returned 4.4%. Year to date, we have 2.8%. But on average, I think this market has returned around an average just slightly below 2% in the last 10 years, which is sort of like an indication of where Singapore dollar yields are. On the corporate front side, you can see here it's slightly higher. It's around 3 to 4% around 10 years ago. During COVID, it declined to around 2% level, spiked up again around 4.8%. And currently it's around 3.6%. A year ago or 2 years ago, I was speaking here at the SGX talking about this ETF, and we've been talking to clients to capitalize on the attractive yield levels of the market. And they have, if they did buy into this index in 2023, at the start of expectations that inflation is going to ease, the returns in total would be close to around 13 to 14% since. And so this decline in yields from 4.8% to currently 3.6% has led to the recovery of the Singapore corporate bonds. And if you look at credit market or bond market in general, compared versus Asia local bonds, compared versus Singapore bonds, government bonds, I see this market has been performing quite well because it's well held. You can see in the period when Credit Suisse defaulted in 2023, the yields slightly picked up, but it didn't sell off quite significantly. And so similarly, early this year, we still have inflation concerns. Yields picked up, but this market just carried on quite steadily in terms of market performance. So in terms of volatility, this is actually lower volatility. Historically speaking, the volatility since 2013 is around 2.6 to 3%. Compared to the Singapore government bond ETF, which is around 4 to 4.5%. And if you compare it with Asia Credit usually has around 4 to 5% of volatility as well. And so one of the cases that I've always talked about why buying Singapore corporate bonds is its additional credit yield. So you have a yield pickup. it's lower volatility. And if you are afraid of duration, it's actually lower duration given it's around 5 to 5.5% of duration. So that's been the case for Singapore dollar credits. On the other hand, if you buy into the ABF government bonds, it's really a asset diversifier, meaning you are putting in it because you have risk of stance, you're concerned about recession, and that's why you buy a government bond or a government bond ETF. So in summary, our case for Singapore dollar bonds is, of course, it's not written here, but if you're afraid of currency exposure, you want to stay home, this is the asset class you look at. If you look at a lower volatility asset class, you look at Singapore dollar bonds. If you want to diversify and improve your diversification in your portfolio and improve the certainty of your income, that's when you consider Singapore dollar bonds. As we've said, interest rates have adjusted to an attractive level. Some of you may have invested in Singapore T-bills because they've been attractive. Last year, they were around even higher than 4%. Currently, it's around 3.4%, just for 6 months. But if you want to lock it in to a longer maturity kind of asset class, then that's when you consider a bond ETF, which is giving you 3.6% for corporate bonds, and for government bonds, around 3%. Corporate bonds, as they say, additional credit spreads. Investment grade credit in Singapore is relatively more stable. We don't have high yield in this bond portfolio or in ETFs that we have. And so we're sort of like immune to default risk. The market has defaults. 10 years ago, you have headline defaults in the market, but those are high yield issuers in the Singapore dollar space. We didn't hold or don't hold those bonds in the Singapore dollar corporate bond ETF. And lastly, as I mentioned, government bonds perform well when it's a risk-off environment. So it's the defensive asset class, performs well in 2020, performs well during the global financial crisis. So this is your diversifier. When equity markets are selling off, government bonds perform well. So this asset class is you look at as a defensive asset class. It's not as sexy or as exciting as equity, but a lot of risk sort of like concerned investors. And if you're investing in Singapore dollars, then this is the asset class that you look at or put in an allocation to, which is what's being done by the StashAway portfolio, Singapore investing, which has around 20 to 40% of these two Singapore dollar bonds. So that's it for me, and I'll move over to the moderator. Yeah, thank you so much.
Hi everyone, May here from StashAway. So we'll move on to the Q&A. We have really good questions, but again, if anyone has missed out, please feel free to scan this QR code, and we will also then basically have our panel answer your questions, right? So if we could just have the question on this big screen for everyone. Perfect. Okay, so we'll try our best to answer as much as possible. We do have some really, really good questions here, so I'll just start. So the first one, I guess, Wei Shin, perhaps you'll be in a better position to answer this. So is there any data of inflow, outflow of money from local or foreign investors into the STI at this point in time?
Maybe I can just speak off the cuff with one of the broader trends that have taken place is that the amount of foreign interest in Singapore over the years has actually been a little bit more on a decline. And actually the local investor is obviously a lot more interested in the yield-seeking side of the STI attributes have actually grown more in importance. So I think the split today from the weightage of local funds versus foreign funds has actually grown a lot more in favor of the local. That said, I think clearly when we look at the outlook going forward, Singapore does have a more defensive characteristic. So when there is clearly the appetite for more defensive opportunities in Singapore, there would be a growth more coming from foreign investors. So this is probably what my comments would be for the first question. I don't know whether there's any point to add.
Maybe just to add on as well, on STI, probably the easiest way to access it is through the ETFs, which I think was shared earlier on one of the products that Nikko managed. So there are two STI ETF on SGX today. The AUM sum up to be just around 2.5 billion Sing. In fact, the combined AUM was less than $1 billion in 2019. So it took about nearly 17 years since the first STI ETF was launched to hit $1 billion. And because during COVID, I think most of you should know that there was a sharp drop even for STI. It reached sub 2,500 points. The following 17 months, right, it took off another $1 billion. So it hit the 2 billion threshold on the 17th month. But for thereafter, you can see STI is now inching upwards, probably hit close to 3,005 index points. Recently, due to probably the Fed rates concern, there was some sell-off in the banking sector that resulted in a small correction in terms of the price levels. But we are still seeing investors using ETFs at least as a tool to gain access into it. In fact, in Singapore, probably STI ETF is still the largest equities ETF we have on the exchange. And we are seeing investors using it. Of course, we don't see a consecutive amount of inflows because ETF sometimes is used as a tool for them to rebalance their portfolio. But all in all, I think the net flows we are seeing it positive, at least for the ETF front.
Okay, thank you. So there's actually a related question that's not on the screen. But one of the questions is actually with regards to investors. How competitive is the SGX compared to, say, Hong Kong or Japan? So I'm not too sure who is more adept at probably answering this.
Is that price returns? I suppose in terms of the benchmark returns, and obviously, I think if you look at the recent performance, you'll be happier if you have invested into Singapore compared to Hong Kong, because of the very China tech-heavy index that HSI today have involved into, because of the listing of companies like Tencent, Meituan, etc. That are very China-heavy, and the price performance didn't help the index. Japan, I think everybody have heard about the awakening of Japan, largely because also of JPY drop in value, and of course some good governance ESG developments that's happening to the Japan corporate reforms. Of course, I think is when you talk about competitiveness, I think you're talking about the companies listed in across these countries, very different in nature. Right? In Singapore, I think probably you're very aware that our STI has a big allocation into banks, into REITs, and the performance of banks, certainly I think if you read the headlines, has been clocking record profits across the banks. So competitiveness, I think if you're talking about performance, I would say in recent history, Singapore probably has done quite well and resilient in terms of its banking sector. And REIT certainly was affected by the rising yield. But again, we are also seeing some positive reversal in terms of the price earlier, first half of the year. It's still a little bit volatile at times, but I think overall net, if the rates is trending downwards, is still a positive development for our second largest sector, which is the REITs, following by the banks.
Yeah, I would echo the comments there. It's really a context of what is the question addressing. Because as one may know, the SGX has clearly a lot more advantages in really a multi-asset kind of portfolio. So equities may not be just a good way to glean on whether SGX is competitive or not. The Singapore stock market, you can say that it's fairly boring because a lot of the companies are high dividend paying, and REITs are typically also very income-seeking markets. So if your view is about pro-growth, buying growth companies, it's not exactly that SGX is not competitive. It's just you don't go to SGX to find companies like that. You probably go to markets like the S&P and all that. But in the area of REITs, I would say that SGX has gone a long way to really build that as a hub for REITs or business trusts. And we think that's a very good testament of the success for SGX in the arena of growing REITs. So that's maybe where I would just echo some of these comments.
Okay, so now on the topic of REITs, one of the questions is, are REITs still a good buy when companies shrink offices and businesses move online? So obviously this is quite prevalent in the last couple of years, right? People shifting to remote work, a lot of companies allowing downsizing. Yeah, so I mean, Kenneth, what is...
Right, it's a good question. Clearly, REITs have different subsectors. So when you talk about specific office REITs, I would agree that that's probably one of the less attractive REIT subsector within the overall cluster of REITs. When you think about different subsectors, you would have logistics, industrial REITs, retail REITs, and business trusts as well. And I would say that offices clearly has one of the greater headwinds. Number one, you have that, the falling demand from obviously disruption post-COVID, and also the rental likely declines that you will see as a result of that. But I think also to put things in context, the supply fundamentals for office is also fairly tight. So it's not necessarily that bearish. But when we think about really office REITs, it is actually not our preferred asset class within some of the sectors. And you heard me present a lot more about logistics, the story of e-commerce, and obviously the ability for Singapore to continue to succeed as a hub for FDI. That's largely representative of really where we are more positive on some of the industrial and logistics REIT sector.
Okay, and the next one for Bertram. So if you could just break it down, what does duration for bonds actually mean?
Yeah, so earlier I mentioned duration. So duration is a measure that measures interest rate risk. It says how much is sort of like, it gives you an indication of how much is the return performance given a change in interest rates. Let's say the interest rate of a 10-year bond, which has a duration of around, let's say, 8 years, interest rates go up, let's say 1%, and you have a bond with a duration of 8 years. If interest rates go down tomorrow by 1%, then that bond will appreciate by 8%. But if interest rates go up by 1% tomorrow, that bond will lose 8%. But if this is a low duration bond, let's say a bond that has a 1-year duration, that bond will just lose 1% if interest rates go up by 1%. But if interest rates go down by 1%, it will only gain 1%. So if you go into a bond portfolio, you look at the fact sheet, it will have a duration measure there. That's an indication of interest rate risk, which is how volatile this portfolio will be relative to interest rate movements, because bond performance is directly correlated to interest rate changes.
One point to add, I think duration also correlates very closely to the maturity of the individual bonds. So the good thing about ETFs, again, even a bond fund, is that the duration typically for ETF is quite consistent. The average probably is either medium term or long term. Like for a corporate bond, Nikko was about 5-6 years. ABF was like 8-9 or even 8 or closer to 9 years. Because of you as you are buying into a portfolio with bonds that never really mature, right? And the advantage, of course, you don't have to concern about reinvesting. Like the T-bill that Bertram has shared on is trending downwards. So naturally, every 6 months, you're going to be concerned whether you can still get 3.4, even lower or higher returns. But bonds, the duration is there. So you can look at it as like you're buying into a basket of bonds, which maturity probably around that duration on average. And it will always be around that kind of duration. So you got to be comfortable with that risk involved. So I think the measurement that Bertram shared was good in terms of, yeah.
So I think you have your money market, your SGS T-bills. 6 months is just a duration of less than 1 year. And then you have your 10-year bonds, which is a duration of close to 10 years. So we have bonds in the Singapore market that matures in 2072. So that has duration of around 20-25 years. So if interest rates for that bond goes up by 1%, you return 20% in that single market move. For example, last week alone, interest rates move up by 20 basis points or move down by 20 basis points. So that is an indication of how much your portfolio will be moving around if you're holding a very long bond. But if you're holding a short-end bond, then you don't have to worry about volatility of your portfolio.
What about investing?
So you're just stuck for a good yield for 6 months. But what if 6 months from now yields is only 2%? So yeah, you'll be reinvesting at a lower yield.
Okay, so in the next question, Bertrand, just now you mentioned that there may be a couple of rate cuts forecasted, right, at this point. So if the US does decide to go aggressive in the next, say, 4, 5, 6 months, how would this actually affect the local market here in Singapore?
I think, as I mentioned, we're very highly correlated to the US Treasury market, although not at the same size in terms of market moves. But we still think that interest rates will also go down in Singapore. And so that would be positive for the interest rates going down and fixed income market performing well. And so I think it's just your seesaw, interest rates going down, bonds prices going up. Yeah.
Okay. Yes, please.
Just on that idea of like whether the US could go aggressive on interest rate cuts, according to the data, it's for the US to go aggressive, that would mean a major shock to the economy right now. Currently, the data in the US show that it's not quite at that point. So barring that, fingers crossed, right? CPI is out tomorrow. Barring that, I think those that sort of aggressive cut is less of a base case for us.
Okay. Next question. I guess why Singapore with sound policies, increased AUM, group valuations did not translate to the Straits Times Index price performance? Does it mean the Straits Times Index is not suitable for buy and hold?
Well, I guess it comes down to your expectation. Again, going back to the question about SGX, is it a competitive market versus the Hong Kong Exchange or that? It comes down to your expectations. If you expect the SGX to be a high growth, exciting growth market where earnings are going to grow 20%, that feeds into the second point I can touch on at the same time. You're going to be disappointed. I think, to be honest, if you look at Singapore's long-term performance over the past 10 years, we're talking about a 5% annualized return. So if you're happy to own STI and get a buy and hold return of 5%, you're probably going to continue to get that. The question is, if you're expecting high single-digit returns, then you have to think about a lot more of where it's going to come from. It's going to come from better earnings coming from companies that you better select outside the STI or within the STI. So I think that's really more the crux of the question. I do feel that we have a fundamentally sound regime. The valuations are cheap, but whether Singapore STI can trade up to 15 times, I feel it's a bit unlikely because, again, 15 times is more reflective of a market that has higher growth potential. So when we look at the STI going forward, we think the earnings growth, especially going to 2025, will be more in the single-digit returns rate. So I think that's going to be probably more in line with a more mid to single-digit or even possibly a higher single-digit return that could be reflective of that. So the second point, which I can also touch on, and I think it's a very good question, is a good question because I believe that one has to really understand what is the source of DPU or dividend per share increases. One of our philosophies in dividend investing is you don't buy dividend stocks because of high dividend. You buy dividend stocks because of dividend growth. And it's because of growth in dividends that really becomes the future compounding efforts or the ability of a company to do well. So we think that the reason why US companies are able to increase dividend growth is because they have faster earnings growth. It's quite straightforward, right? Because the faster your earnings are growing, your ability to increase your payouts are also increasing. That doesn't mean that Singapore is bad, but it just means that, again, the ability for them to surprise on DPU growth is probably less. It's probably most reflected in REITs versus STI. For example, the STI will give you some growth, but because REITs, for the nature of their business, is not giving you much DPU growth, a lot more of that returns will come from the yield instead. So one has to look at always the total return proposition between dividend growth or the growth of the company and dividends as well. But that's basically, again, very reflective of Singapore's demography as a lower growth but stable income generating market.
So kind of on that note, there's also another question. It's not on the screen, but basically someone has asked, you mentioned that the current average yield for STI is about 5%. What circumstance will actually make this yield drop?
Okay. Well, obviously there's this is the scenario where if your market goes up 20%, then in theory that will come to 4-ish%. But I think what the question is addressing is more to do with the risk factors of dividends disappointing. And that will again go back to the risk of perhaps a recession. Because in a time of recession, in the past few episodes that we had in Singapore, earnings have fallen in the region of 10 to 20%. And when earnings do fall by that magnitude, you'll be quite sure that the very stable stewards will also start to cut dividends. So that would be the source of risk if we do get a major recession or a major economic shock that would really threaten the ability of companies to sustain those dividend payouts. So I think that would be the greatest risk factor of that coming down to a 4. I do feel, however, that in the current investment climate, it is quite unlikely. And I would say that over time, there is probably more room for expectation for that dividend to grow, even though it's going to be not as significant compared to some of the other markets.
Okay, thank you. I know we are slightly over time, but if you could just give us a few more minutes, because there are actually some really good questions that I think we should really answer. So the next one, I think, Bertram, this is more for you. So the ticker NER related to US, is it related to US or Singapore inflation? If inflation does drop below 2%, should we expect a depreciating Sing dollar?
Sing dollar near neutral stance is usually on an appreciation stance. It's an appreciating slope. You can see it in the long history of the Sing near. If inflation drops below 2%, I think we'll just go down from a sharper slope to a more stable, lower appreciation stance, but it's still going to be an appreciation stance versus the SGD trading basket across currencies. So on a neutral market perspective, where inflation goes down to its normal level of around 2%, we'll be seeing a Sing dollar near that's slightly appreciating versus the rest of the market, other currencies in the basket. We don't expect it to be that stance wherein you have an inverting Sing near. We've never seen that. So the standard neutral Sing near slope is on a positive slope. And I think if it's going to be depreciating, it's more like when you have this adjustment, so it's going to be recentered, and that's only because of recession risk. So when there's recession, the Singapore dollar near is usually recentered downward. So that's also like sort of like I'd say depreciation, but that's because to support the economy from that perspective.
Okay. And also, I guess the next one, Bertram, it's for you. So if yields are expected to go down, is then a good time to consider bonds as part of my overall strategy? Sorry, the questions are not showing up on screen. There you go. Yep. So if yields are expected to go down, is then a good time to consider bonds as part of my strategy?
Yes. I mean, in a multi-asset portfolio, if yields are expected to go down, there are some reasons. For now, it's because of inflation adjusting to its normalized level. But if also yields are going down because of recession risk, then that's also an added reason for you to invest in bonds, because bonds are a defensive asset class. When equities are selling off, bonds will be performing well because yields are going down because of recession concerns, recession risk, which you saw as an example during the first week of August. So I think that's just an example of how markets can turn when there's a recession concern. So always consider bonds when there's recession risk.
I see the next question, which is really quite a bit amused. It's a bit of a trick question, just to say that is it foolproof to buy into any REITs now? I would just answer it in the context that obviously nothing is foolproof. I would just mention again one of the points that's very important to understand for REITs. While it's very clear that a decline in interest rates will help fixed income, will help REITs, when we look back in history, times where we do run into a recession, that becomes very tricky because the recession risk clearly can negate the effect of obviously the duration side, which is really where rates fall. And by virtue of that, you should buy REITs. because again, we didn't really cover this in detail, but it's obviously the corporate credit risk, and that will also apply for REITs, because we have seen episodes in the past where interest rate did come down, but REITs also delivered negative returns. And these are times usually when we have recession or with a very weak economy. So the caveat here is actually more to do with how the economic trajectory is for global markets. If we do hit a very major recession, if rates are cut because of that, I won't be as confident in saying that REITs can actually do very well. So I think that's the really one caveat that you would like to highlight to the crowd here, who is obviously thinking that it's a sure done, it's a sure deal to buy REITs right now, or bonds for that. And bonds is a bit different, because bonds, clearly you have that sovereign, especially for the ABF, that to me, government bonds are safe, so they would definitely benefit. But corporates is also another thing to consider.
Although yields will go down, as I've shown earlier, credit spreads can widen. We saw this during the COVID event, wherein spreads doubled from around 100 basis points to 200 basis points. That's when credits underperform government bonds. So really the performer during recession is government bonds. And credits really depend on the composition of the underlying credits in that portfolio. Yeah.
One point to note, I at least on the sentiment perspective, indeed we do see more retail investors buying into REITs, a lot of inflows coming from retail net buy. In fact, for REIT ETF as well, for those who don't know which REIT to choose, and for fear of choosing the wrong one, REIT ETF is a good way. And we also see a pretty strong retail buy interest, including into the AXJ REIT ETF in recent months since start of 2024.
Thanks. Okay, so the next two questions, I believe it's for Justin. Oh, okay, there you go. So Justin, the first one, they both relate to ERAA. So the first one is, does your investment model rebalance the underlying assets during the various cycle changes? So that's the first one. The second one's not showing up, but I'll let you answer the first one first. Yeah.
Sure. So in short, yes, it does. So based on where we are in the economic cycle, our model will allocate to the asset classes that perform best and optimize based on your sort of risk level to minimize risk and maximize return. So in short, yes, we saw that happen in April, as I showed earlier. So we moved from sort of shorter duration, sort of safer assets to higher yielding, more risk-on assets into, as I mentioned earlier, into the Straits Times, into different sort of bond sectors and away from sort of money market funds. So that's how we did sort of reallocate based on the change in economic regime. And as it does sort of move and as it evolve, our macro model does monitor the economic data in real time. We have proprietary economic indicators, as well as sort of forward-looking nowcasters to monitor where we are in an economic cycle. So yeah, and I guess I can sort of look into the second, or talk about the second question.
So the second question is not showing up. Okay, so it's what may cause ERAA to really switch from inflationary growth to stagflation, or worse, directly to recession?
Sure. So it's essentially triggered by the data. So whenever it crosses a certain threshold, when inflation increases or decreases below a threshold, when growth increases or decreases beyond a threshold, then that's when it will trigger a reoptimization to sort of move into asset classes that best perform under that sort of economic regime. So,
okay. I think the next question is for Kenneth and probably your crystal ball. So how do you actually see the probability of the economy falling into a recession based on data and? Oh, Justin.
I mean, yeah, I think it's a base case. It's the economy currently still looks pretty robust, pretty strong. The labor market data in particular, if we're focusing on the U.S. in particular, it's still quite healthy. Of course, it is cooling. But there's a distinction between cooling and collapsing, and right now we're seeing cooling. So barring sort of a further snowball effect or a big shock, I think right now our base case is that we can still remain in this sort of I guess Goldilocks period of like a soft landing or no landing even.
Yeah, I would just also add that I think it's a low probability. I think when you look at consensus, and I think this is a poll in the US, many of the US investment houses are all putting a ratio of 15-20% risk of probability of going to recession. I don't think my view is too far from that. And even we need to also understand that we are always in this period of August, September, October, where it's always very easy to become negative. And I think one of the reasons why we had this volatility was also triggered by obviously some of these exogenous factors that probably caused a lot more, I would say, noise around the cause of that recession. So I think that's, to me, it's probably more a bit extreme, and I do feel that the risk is actually much lower in that regard.
From our team view, it's sort of the same level of expectation in terms of probability of recession. It may have increased, but not so much from our base case view. We're seeing more soft landing, and we see that in the market currently. There was an overreaction in the yields, and it has corrected back again. So there were probably some that hedge funds or automated trading that triggered yields going down sharply, but it has gone back to where we started in August.
Okay. So we'll take one more question because we're fast approaching 8:45. So the last one would be, given that the US is one of Singapore's close partners, will the results of the upcoming election in November affect the local markets in any way?
Yeah, I will just take the equity side of the question. I don't think it will be as meaningful or significant whether Trump or Harris wins. I would just say that the likely difference would be clearly, obviously, more felt on the US dollar, and how the US dollar naturally, which would be seen to be more, in favor of a stronger dollar with Trump, and the other being Harris. So if a stronger US dollar clearly would be, I would say, a greater risk for not so much just Singapore, but Asian, equity markets. I think historically we have seen Asian equity markets, including Singapore, do better in a more, a time of perhaps more graduated US dollar strength or even neutral performance. When US dollar is very strong, and it tends to be more a negative signal for markets. So I would think that in that regard, maybe, clearly when we have less of a risk of a strong dollar, there's room for obviously Singapore to perform better on that front.
I think on the fixed income side, of course, there's some volatility, but it doesn't translate as much to the Singapore dollar fixed income space. You can see when the concerns are on the fiscal front, the long end US Treasury bills may continue to be high. I don't think that will impact Singapore dollar bonds directly. It's really when the new government will impact the growth aspect or the inflation aspect, that's when I think it will impact Singapore dollar bonds directly from a yield perspective.
Okay.
I know we have run out of time, but I like the second question here, which is something that's quite close to what I'm focusing on. And it's a question about SGX, whether it has initiative to improve market liquidity. I think it's not so much about SGX, it's more greater for Singapore, whether there is, I'm sure many of you have read, there is clearly a panel looking at how we can revitalize the Singapore market, and especially for companies which are more in the smaller cap, mid-cap space. I think it's a good timely kind of a lens on how Singapore has fared. Being an asset manager, very active in the space, I do see there's a lot more greater intent by the authorities to consider this seriously. So I'm actually cautiously positive that there could be future steps, and we hope for SGX and for asset managers that there will be a greater impetus to launch ways to actually revitalize the market. So I would say that there is initiatives in place, and we look forward to seeing some of that. And I think that will be really more in the area of where we look at companies, we always try to find what is underpriced. This is the natural DNA of any stock picker or fixed income investor. And when we find SGX today, we think that there is clearly a lot of undervaluation in many of the companies there. And that could actually be a good, interesting development, that if the initiatives lead to better liquidity, it could actually re-rate quite a bit of the older times where some of us may remember Singapore was actually quite interesting as an investment destination. So looking forward to some of these changes.
Okay. And with that, thank you so much, everyone. And especially thank you to Kenneth, Bertram, Justin, as well as Rachel. And for everyone else, Nikko, StashAway, and SGX will be outside. If you have more specific questions, we're more than happy to answer them. Thanks so much for your time and